Let's just say you've been waiting to move for what seems like forever. Either you've outgrown your home, maybe your family has grown and you just desperately need something bigger, or maybe it's time to downsize. But for whatever reason, you've been needing to move, you're tired of waiting, but today's mortgage rates are making it impossible. Well, this video is for you. So let's go on this journey together. Let's talk about how we're going to get you into a 4% mortgage rate. But here's the catch. These options aren't advertised. Most realtors don't even understand them. And if you don't know how to structure the deal correctly, you'll miss out entirely. So I want to show you 3 proven ways buyers are actually doing this. All right, let's start with the first strategy, the forward commitment. This is a great option if you're a first-time home buyer or you haven't had the time to build up a big down payment. With a forward commitment, you can buy with as little as like 3.5% down. And in many cases, the builder can cover your closing costs too. But there's a catch. It only works with new construction. So in Dallas, that probably means looking at communities out in the exurbs, okay? So think places like Salina, Rockwall, okay, Princeton. If you're hoping to buy like in the heart of Plano or Irving, where new construction is rare or even like non-existent, all right, this isn't gonna be your path to a 4% rate. But if you're flexible on location, okay, this can be one of the most affordable ways to buy right now. So how does a forward commitment actually work? Well, according to mortgagemark.com, a forward commitment is a home builder's promise to deliver a certain amount of loan volume to a mortgage lender. A lender will lock the predetermined volume at a particular interest rate in exchange for a fee from the home builder. They continue saying a forward commitment is a block of a single loan product, meaning every loan in the forward commitment must be the same loan type and the same duration. So you'll want to look for the fine print to see which loan type is being offered. Another thing to note is that it's not considered seller concessions. So you are not going to find this in the contract or the closing disclosure. Forward commitments usually come with a time limit. All right, they're locked in 30-day blocks. And most builders go with a 60 to 120-day window. If they don't close enough homes in that time frame, they often have to pay extra to extend the rate, which adds pressure on them to get deals done quickly. And that's good news for you, because it means the builder is motivated to offer incentives and close fast. Although, since the rate is so far below market, those homes tend to sell fast anyway. Just keep in mind, this strategy, okay, it only works on quick move-in inventory homes, not new builds from the ground up, because those can't be finished in time to meet the deadline. One of the best parts about forward commitments is that the low interest rate isn't tied to a specific buyer or home. It can be transferred to any qualified buyer and applied to any eligible property. Now that said, the builder can and often does pick only specific homes that they'll offer the forward commitment on. Sometimes it's a huge amount of choices. I mean, it could be even like any inventory homes in a whole community, but sometimes they'll narrow it down to where it's only a few specific homes. Now, I want to share with you a worst case scenario for builders, because their worst case scenario becomes your opportunity. When they commit to a forward commitment, they are agreeing to pay a fee regardless of whether the funds for the loans get used. So imagine a builder locks in, 1.35 million in low rate loans. And remember, they have to use those purchased loans within a certain time frame. Say they don't close a single home in 60 days. To keep the rate, they pay an extra like $6,750 for a 30-day extension. But even after nearly 4 months, if nothing sells, they're still on the hook for the full $54,000 fee. That's the risk, okay? They're paying up front, whether the homes sell or not. Do you see that forward commitments are truly a commitment that the builder has to make in advance? If the builder can't get buyers for these homes, he still has a fee to pay because he's committed in advance. So how common are forward commitments? All right, are you likely to find one for a home you love? All right, well, just for fun, I conducted a little experiment, okay? I set my stopwatch to see how many new construction builders I could find offering a forward commitment. Well, in 15 minutes, I found 7 offering a 4.99% fixed rate or lower. All right, here's what I found. D.R. Horton is offering a conventional 30-year fixed rate mortgage at 4.99%, or a 3.99% FHA 30-year fixed rate on select inventory homes in Texas. The rate requires a 2% discount point, but that cost can often be covered by the builder as a seller paid incentive subject to loan program limits. And then we have Coventry. Coventry is offering a 2.99% rate the first year, a 3.99% the second year, and a fixed rate of 4.99% for years 3 through 30. Then we have William Ryan Homes. They're offering rates as low as 4.5% based on a FHA 30-year fixed rate mortgage with a 3.5% down payment, buyer with FICO score of 680. Then we have Meritage. Meritage is offering a rate lock program as low as 4.99% for 30-year conforming, conventional, VA, or FHA owner-occupied loans. Then we have K. Hovnanian. K. Hovnanian is offering a 2-1 buy down starting as low as 2.99% and ending as low as 4.99%. Trophy Signature is offering a 4.99% for FHA plus $7,500 toward closing costs, or 5.99% for conventional plus $10,000 toward closing costs in select communities. These forward commitments are everywhere. In fact, every single builder website I went to was offering a rate buy down of some sort. They just weren't all forward commitments. So read the fine print and watch for the final fixed interest rate. Okay, that's what matters here. You'll find some incentives are just the 2-1 buy downs, right? Those aren't nearly the catch because you'll have a lower rate for a few years, but then years 3 through 30 are gonna be at market rates. Your very best option is the 2-1 buy down plus forward commitment combo. Several of the builders I mentioned have this option. With this loan, you get a 2.99% rate the first year, a 3.99% the second year, and a 4.99% for years 3 through 30. Now, since I mentioned the rate buy down, let's go ahead and talk about that, okay? How we're gonna be strategic with those, because those are our second option. Well, rate buy downs are really a good fit for both entry level and move up buyers, even buyers who have like 0 down payments, okay? You can use the rate buy down with 0 down payment loans like USDA and VA loans, or you can use conventional financing with as low as like 3% as your down payment. Rate buy downs aren't limited to new construction like forward commitments. You can find them in pre-owned homes too. A builder can advertise for them, but a pre-owned home seller could too. The difference would be that with pre-owned, the buyer's agent would have to know how to structure the offer, and many realtors don't understand the process or the terminology. A rate buy down can also be for all loan types. So this is our most versatile way to get your mortgage rate down, but it does have some significant restrictions. So let's go ahead and talk about that. Remember how the forward commitment happened well before you as the buyer entered the scene, right? The builder was making decisions about lowering the rate and then committing to it well in advance. Like it didn't have anything to do with you other than the fact that you had to qualify for a certain type of loan. Well, a rate buy down is not like that at all, okay? It's tied directly to your deal, whether the seller is a builder or a regular homeowner. Now, something important for you to understand here when it comes to rate buy downs, okay, and this is important, is that mortgage companies are not gonna keep your loan. They are not gonna service your loan. They wanna sell it off to someone else, okay? And that someone else is quite particular. In fact, they put a lot of limits on how much can be paid towards your rate buy down and closing costs in general. And this is where what we call seller contribution limitations come into play. Now take a look at this form, all right? You can see that seller contribution limits vary by loan type and down payment. FHA and USDA loans allow up to 6%, even with low or no down payment. VA loans cap it at 4%. Conventional loans, okay, they're more complicated. Limitations there are going to depend on your down payment. Now, you might be wondering what sellers can contribute for and what counts against that limit, okay? And those are good questions. All right, any costs that are considered non-recurring closing costs or prepaid items apply toward the cap, and a lot are gonna fall into that category, okay? Now, there are items that don't count toward the contribution limit. So let's talk about those, okay? Your first one is realtor commissions to, like the buyer broker or the listing agent, paid at closing. And then the second one is lender paid credits that are paid through like rate structure. I dug a little deeper on this with our preferred lender because I really want you to have these answers. So paying off a buyer's lease, for example, okay, could we do that? Well, does that count toward the contribution limits? Yeah, it actually would still count, even if paid directly to the apartment complex. Any seller paid item that benefits the buyer is generally subject to the limit, regardless of who the check is written to. All right, how about repair allowances, okay? Are those subject to the limits? Yes. And this one's important, okay, because you can be strategic here. Direct credit to the buyer for repairs is not allowed, whereas credit paid to the vendor at closing is, but it still generally counts toward the limit unless it's structured really carefully. Okay, so here's what I mean. For the seller to cover repairs without it counting as a contribution, okay, you ready? Repairs must be completed prior to closing. They've got to be paid directly outside of closing and not reflected on the closing disclosure as a credit to the buyer. And if the payment is showing on the CD, okay, whether to the buyer or the vendor, it typically is going to count toward the contribution cap. So important note on this, if you're planning to use this strategy to get your rate down and you'd like to have some repairs done, you want the seller to complete them and pay for them prior to closing. Okay, you do not want the seller giving you cash for you to complete the repairs, or even for the seller to include paying the contractors through the title company. Either of those approaches will apply towards the maximum seller contributions. Well, now that you've got an idea of the restriction side, let's go ahead and talk about how these rate buydowns work. According to Bankrate, today's rate is 6.69%. Okay, with a permanent rate buydown, 1% of the loan amount lowers the market rate by 1/4%. So you can have the seller pay that rate down by as little as 3/4% or as much as 2.25%, depending on your loan type and down payment. I mentioned earlier that you could use the rate buy down even with no down payment at all. Now, that being said, your biggest benefits go to your move-up buyers who have those big down payments. All right, if you have a 25% down payment or more, the seller can pay up to 9% towards your closing costs, which you could use to pay your rate down to 4.4% fixed rate for 30 years. So there is strategy here, okay? Because instead of using your money to pay the rate down yourself, use it to increase your down payment so the seller can pay up to that maximum amount. Temporary buy downs are handled a little differently than the permanent buy down, and it is extremely important you understand this difference, okay? So let's talk about that. First up, let's talk about how it works by checking in with Fannie Mae, okay? It explains a temporary buy down is a way to lower your mortgage payments for the first few years of the loan. It works by putting a lump sum of money called a subsidy into a special account at closing. That money is then used each month to reduce your payment. One common example is a 3-2-1 buy down. Your interest rate is reduced by 3% in year 1, 2% in year 2, and 1% in year 3 before going up to the full rate for the rest of the loan. Now, the key thing to know is that your official loan rate never changes, okay? It's just that someone, like either the seller or the lender, is covering part of your payments early on to make it more affordable up front. So once that subsidy runs out, you start paying the full monthly amount. So what are the terms and restrictions for a temporary buy down? Well, it is maxed out at the 3-2-1, okay? The very important distinction between the permanent rate buy down and the temporary rate buy down, okay? And it's really important that you know this, is that with the permanent, it is once and done at closing, all right? If you refinance or the loan is paid off, you won't recover any of the money that paid down the rate. With the temporary buy down, money is basically put into an escrow account that is used little by little every month. If you refinance or you pay off the note, okay, whatever's left in that escrow account is refunded to you. So I hope you understand the difference there, because so much depends on your level of risk that you're willing to accept, as well as how long you plan to stay in the home. All right, next up, let's go ahead and talk about our third way, which is assumable loans. Now, with this strategy, you're not stopping at 4%. Like, you could literally get a rate for as low as they went in 2021. We're talking like 2.5% in some instances. This is really only a good fit for the move-up buyer who's just sold their home, or anyone who has cash for a large down payment. The other thing about assumable loans, they're going to always be pre-owned homes, not new construction. All right, so let's talk about how these work. In a nutshell, a loan assumption allows a buyer to take over the current owner's mortgage with the loan terms, including the repayment period and the interest rate remaining the same. Now let's be clear here, assumable loans are not going to work for everyone. Not every loan type qualifies. All right, here's a quick breakdown. FHA loans, generally assumable with lender approval. VA loans, okay? VA loans can be assumed with lender approval, but the seller must give up their loan entitlement, which is something that many are going to be hesitant to do. Still, if you are VA qualified, it could be the perfect fit. We also have USDA loans. These can be assumed either with new terms or the original ones, but it's usually in family transfers. How about conventional loans? Rarely assumable. Rarely, okay? Sometimes with an adjustable rate mortgage that doesn't have a due on sale clause. Assumable loans probably sound too good to be true, right? You're probably wondering, like, what's the catch? And first, awareness is low. Like, many people don't even realize assumable mortgages exist. And those who do often have bad or outdated information. The second hurdle, you'll still need to qualify with the original lender. So just like with any mortgage, we're talking credit, income, debt to income ratio, all of that, okay? But if you're planning to buy anyway, okay, that's going to be part of the process. Another important limitation you need to be aware of is that assumable loans are mostly government backed, which make up only about 18 to 26% of loans in recent years. So you'll need to do some digging to find a home that qualifies. And like I said, assumable loans generally require a large down payment. The assumed loan only covers the seller's current mortgage balance. You're going to need to cover the difference between that and the purchase price. Let's take an example. Say my client Bob has a VA loan at 3% and he owes $400,000 on a house that's now worth $500,000. A buyer could assume the $400,000 loan, but they would need to bring $100,000 in cash to closing. So that is a big chunk. But the buyer gets an incredible interest rate, and Bob gets his equity out. So it's a win-win. Now, who is this not for? Okay, if you're scraping together a down payment, this is going to be a stretch, right? But if you're selling a home and you're bringing equity to your next purchase, okay, assumable loans could unlock some serious savings. Okay, so how do you find homes with assumable loans? Well, a knowledgeable realtor can dig into the MLS and the public records to find out what kind of loan a seller has. Mortgage records are public, so the data is out there. You just need someone who knows where to look. Also, terrific website, okay? You ready for this? The website withrome.com is an excellent resource for finding assumable loans. So your goal here is clear, all right? You find a seller with a government-backed loan, a low interest rate, and then if possible, limited equity. So it may sound like a needle in the haystack, okay, but with the right guidance, okay, these opportunities are definitely out there, and obviously they could save you thousands. Now, I do want to discuss a very big concern, especially in regard to the forward commitment and the rate buy down. And here it is. The seller, and especially when the seller's a builder, okay, they want to recoup their cost. Remember, either way the rate is paid down, it's going to cost the seller money. So you're at a real risk here of overpaying if you only focus on your monthly payment. So here is where you must really, and I mean really, rely on the comparative market analysis. All right, you need those sales to be your anchor for what the list price should be. Builders in particular are notorious for overpricing their homes to pay off the rate buy downs. It's your realtor's job to provide the information on sold homes to help you make sure that doesn't happen. Now, why do I say it's the realtor's job? Okay, because Texas is a non-disclosure state. An unlicensed professional does not have access to closed sales, which is why you as a buyer become particularly vulnerable if you're only paying attention to the monthly payment. So these 4% rates are real, okay? They are a gift that informed buyers are using right now in 2025, okay? So, and you could be that same informed buyer now that you've watched this video. You just have to be aware that your biggest risk here is overpaying, all right? Don't just take my word for it, okay? I made an entire video about this problem with overpaying and tons of examples of it happening. If you're interested, you can check that out right here. In the meantime, this is Wendy Pinnell, and I will catch you on the next video.